Every lender is going to service a loan differently. So if one lender says no, that doesn't mean anything.
Just because it's grown a bit doesn't mean the cycle's over. Fundamentals need to change for the cycle to be over.
I think it's definitely going to be that sort of front-loaded effect where people who do get in first, they're the ones who experience and generate that wealth earlier.
Property, as much as we like to say it's the game itself, property is actually the game of finance. On the Property Nerds show, we love mixing it up, and this time it's not with guests, it's actually with Adrian and Jack, the co-hosts here of the Property Nerds. We're talking finance mistakes. In fact, we're talking about 3 mistakes in the finance world that we want to dive into that you've got to avoid. Now, the cool part about this episode, though, is we give you a bonus 4th one. So stay till the end, which means, like, I've just called it 3 finance mistakes in this episode, but actually should be 4. But you get the point. Let's have a bit of fun, getting casual in this chat, catching up with Jack and Adrian, having a bit of fun on this chat. Tune on in, you're going to learn some of the mistakes that people make in the banking world and how brokers have helped people get ahead and avoid them, but also real stories. Every one of these mistakes is equipped with real stories for each and every single one, from clients to team members, making sure we can leave you in a position to avoid making these in your future. Check it out.
Nerd alert!
Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Well, we're back in again, gents, for another episode of the Property Nerds podcast, and today's another finance special, hence why we've got this man in the middle. Got the hot seat today, mate.
Happy to be here, mate.
Well, finance mistakes. I think this is a good thing to talk about today because we want a whole bunch of people listening in to stop making them, right? And when it comes to finance mistakes, before we get into those, there's some events that have been taking place recently, and one of them is interest rates. Interest rates coming down in August, Jackie.
Mm-hmm.
Good news for repayments, good news for borrowing capacity. But me and you were chatting off the line before, and you're like, Arch, it's not always good news in a few areas, and I wasn't sure what you meant.
Yeah.
What are the banks doing that makes you feel like it might not be good news or there's some tricks being played?
They're very sneaky, mate. They're very sneaky. So this came up when we had a client who we had a deal package for him ready to go. We had a pricing approval done. It was ready to go, right? And they said, I think there's going to be a rate cut. I just want to hold off until that rate cut comes in. And I've seen this before. And basically said to the broker that I was dealing with, I said, look, if they wait, because what happens, the lenders do a pricing request and they'll give you like a pricing discount of, their base rate is 9% and then they'll give you a 3.2% discount, right? So you get that pricing request discount and just for example, to give you a 6%, right? Then client said, let's wait. We don't want to do any application until the rate cut comes in. We just want to see what happens. And I said to the brokers, like, that's going to shoot him in the foot, right? Because the lender, you think that the 0.25% gets passed down automatically, and everyone assumes that that's the case. But when they've got discretion on the pricing discount, they don't pass down the full 0.25%. They do for their existing book, and they say it's for new to bank customers as well. But they just they don't ever so slightly pass down like 0.22 or 0.20, and that client paying an extra 0.03 as a result of that. That's not much, but
it's the principle.
Yeah, like it's so frustrating, man. Like the RBA, nothing changes for them. The cost of money is the same, but they don't pass on the full discount to new to bank customers.
Okay, so let me play that back. Like, give me an insight if I'm hearing this right. They gave you a special pricing request of 1%.
Yeah.
And then maybe you're thinking, well, 0.25, and this might not be the exact same scenario, but another scenario like it. 0.25 means that now your total discount is the 1% plus the 0.25.
Yeah.
But then you're saying the banks have the power to basically go, we're changing your discount approved to 0.75.
Yeah.
And then you get another 0.25 because RBA, and you're back to the same 1% you always had. Whereas if you had the 1% discount approved, settled the loan, then a 0.25 came on top, because they can't go back on a pricing request because the loan settled, they would then now make it 1.25 off total.
Yeah.
Wow.
So they have the discretion to change how much of a pricing discount that they give you. And because it still looks good, they don't, like clients don't really know exactly what the best rates are across the board. But some lenders that just have a carded rate, they don't have a pricing request. They're the ones that their rates are actually really sharp right now. But the lenders that give you a pricing discount, they're the ones that are playing those sneaky tricks, and they're actually creeping up in terms of interest rate. So,
well, I mean, because we're in the variable world and fixed rates don't last long in Australia, unlike other countries like the USA, slap on a 30-year fixed rate at like 2 point something. They have, like I was in the head office, right, of CBA, and there was a whole like floor of pricing specialists. So like, there's dollars in the game if you've got a floor of pricing specialists working on stuff, right? Like they're working through things there.
How many of these are you kind of seeing within lenders who are not maybe passing this on, or are you seeing more of them doing it as more subsequent cuts come along as well?
Yeah, I think I see it happen at least once every single rate cut. There's always a client that says, oh, let me wait. You tell them not to, the downsides of it. We've seen it before. Doesn't matter. I just want to wait. Okay, no problem. So there's always one, and it's a mix of because not all banks have a pricing system like that, but the ones that do, they'll say that they pass it down for existing clients, but their new to bank clients' pricing is always going to be different.
Yeah.
Yeah, of course.
Now, we got 3 mistakes we wanted to cover off. Obviously, interest rates being one in terms of just what's happened recently is a big event. But before we jump into the 3 mistakes, some big events happening in the finance world or likely to happen in the world of first home buyers.
Yep.
October 1st, first home buyers, unlimited placements, no income caps, and substantial rises in price caps. If, say, we use a first home buyer example, the price cap's gone up to 1.5 million for New South Wales. But if we use an example of a first home buyer at 800,000, where I believe stamp duty is waived up until that point, that means not only did they get a stamp duty waiver at 800, but they paid no LMI, irrespective of the income, and unlimited places. So hypothetically, if someone went out on their own and purchased an 800K property or 799 property in New South Wales, they would only need 42.5K if you're looking at lawyers, pest and building, and a deposit. Anyone who thinks that that's not going to increase prices, you're out of your mind.
It's a massive difference in terms of where it was. Like the price cap was like 800 or 900. Now it's gone up to 1.5. That's, so many more markets are open. And like we were so used to many years of just saying, oh, there's 10,000 spots, there's 10,000 spots. And now there's unlimited spots. So I think the big thing was the not having an income cap. It was so unfortunate to see, people trying to get into the market in their mid-30s, like earning as a couple just over 200K with kids, and the fact that they don't qualify for the scheme. So for those people now, they're in. And then other high income earners, like we've got a couple clients that are up above 200K, single applicants, they wouldn't qualify. They now do. And to give them a budget of 1.5, that's a lot to play with. And that's like, it's a big difference.
How much in LMI savings? Are we talking 40, 50?
Oh man, at least 45,000.
Wow.
Up to the full 1.5, 45,000.
And the crazy thing is, even if, say, someone else thought LMI's cost of doing business, I'm just going to pay it, I'm ready to go, I'll find a unique lender that puts it into my loan or something and takes it up to 98%. What they don't recognize is that it's still a decision, meaning some people do, some people don't. Some people want to make that business decision, and some people go, I want to save more, I hate this, it feels dirty paying that LMI, it feels costly, I don't want to do that. The decision's gone. So even if like the 45,000 savings or the 50,000 savings or 30,000 savings on LMI wasn't an issue and someone could throw it in their loan or index it out of the long term, spread it out of the long term. The thing is, there's no decision now. Paralysis comes from high decisions to make. So that's off. You can just go and make it.
Yeah.
Now, when it comes to that, it's not even New South Wales, it's other markets too. This is going to be a big thing all across Australia. And I think one thing people don't recognize is that sad as it sounds, it's first in, first served. Literally. Because every month that goes by with these sorts of things in play, it's a demand generator. As much as the government thinks they're helping, no doubt they are. Like they are helping. They are helping many people. But
helping people that have property.
Not necessarily. It's first home buyers. They don't have properties, but it's going to help people, but it's like anything. You can't, it's hard. As much as easy as it sounds to say government this, government that, it's hard to create a system that makes everyone like win. Do you know what I mean? If you're a first-time buyer, if you're a late bloomer to this opportunity, you're going to have more cash to save because the price is going to be bigger, right? Yeah.
Yeah, I think it's definitely going to be that sort of front-loaded effect where people who do get in first, they're the ones who experience and generate that wealth earlier. And then naturally, as time goes on, it makes it harder for everyone else to jump in. So it's not to cause any FOMO, but the longer you wait, the worse it kind of gets for you under this as well.
Start saving back now.
Well, I mean, I think like there might be a few segments that, give me an example. There's a lot of people we talked about in another episode with like Melbourne units that are just shocker, like shocking performance, right? I'm talking 10 years ago, bought for 430, 420. Today worth 400 to 430.
I got a story. 10 years ago, bought something for 550. A couple of months ago, sold it for 450.
Wild.
10 years I held that.
Right. But like, it just shows you the stuff there, right? Is that in Melbourne?
Nah, that was in Warwick Farm.
Warwick Farm.
Shout out to Warwick Farm.
Warwick Farm. You going?
Southwest.
But it just shows you major cities like Sydney and Melbourne. But two things though. Housing affordability. Let's just talk about that. If you've got a 450K or 500K unit in Melbourne, heart of CBD, shiny building, facilities right near the CBD in terms of the river, the cafes. And I've said this on another episode. It's like, got it all going. If you just wind it up to 500K, that's 25K needed to purchase that. 25K. Like, that's wild. Plus a couple, like, is it a good purchase for an investment? Hell no. I don't agree with that. But is it a purchase if you're talking about, I want to get my foot into the door, I want a property, I want to get in?
Short-term owner occ, bit of capital growth, sell it, trade up. It could happen.
I mean, a few things like that. But I mean, I guess the main thing we're trying to say here is that this is a huge policy shift.
Yeah.
Huge policy shift.
Enjoying the show? At 4acre Financial, we believe property is a game of finance and we're here to help you win it. Whether you're still building a portfolio or looking to formulate your exit strategy, our tailored mortgage strategies are designed to simplify your journey and supercharge your confidence. Are you ready to take the next step? Visit 4acrefinancial.com.au and book a free strategy session with us today. Let's make property investing less stressful and a whole lot more rewarding.
3 mistakes. Let's get back to talking about that. Enough with the breaking news.
We're going to get to it eventually.
We're going to get to it eventually. So for those waiting, I hope that wasn't too long. But let's talk some of the 3 mistakes.
Yeah, I think, the first mistake that we probably see a lot of, and this is why we always talk about getting the right finance partner and double checking that, or verifying when you do get a no. Hey, is that really a no? Because we've had so many countless occasions where I've talked to a client, they've said, I'm
Bank
out.
says no. No doesn't mean no.
Yeah.
No doesn't mean no. Tagline.
Yeah. So, Jack, did you want to, maybe share a little bit about that around, what can people consider or what do you do in the back end when someone says no, or even if you get a no yourself, hey, what other alternatives do you have?
Yeah. So we had a staff member actually come on into our team, very new. They came from the banking world. So they had an application in progress and it was with their old bank. Just purchase of a land, thought it was all good, everything serviced, no problem. And they got an auto decline based on just having too many credit inquiries. And I looked at the file, I was like, it's not that bad, So, and we had a finance clause. And it's funny, the staff member called me up and said, oh, look, we're trying to get this land and, I'm not very stressed, blah, blah, blah. We got declined. And I'm like, look, I can't help you. I don't know who. No, I'm joking. Obviously, you come to the right place.
When does this mistake turn to a success? It's like, just can't help you. That's the mistake. Listen, learn.
I kind of chuckled. She's like, can you help? And I kind of chuckled. I was like, well, yeah, of course.
Yeah.
And we only had a week, turned it around, got the approval, done and dusted. So, major bank.
Check auto decline.
Yeah.
Are the banks not smart enough to have someone to go, I know the system said this, let me check this out for you, let me roll the sleeves up, I want to help you out here? Like,
mate, there's no common sense. It's uncommon. Yeah. It's just the computer says no. That's it, mate.
Wild.
Yeah.
Just wild.
So in those inner workings of, you just said, hey, gave it a week, turned it around.
Yeah. And it was major bank to major bank. It's not, and it wasn't like it was the client was significantly disadvantaged by going with us. That we actually got him a better deal than they had on offer. So yeah.
What a way to win a staff member to go, you're at the right place. Eh? Like, it's almost as if Jack planned it to go, all right, welcome to the company and loan decline. And look, let me come in and save the day. Yeah. This is the things we do. This is how we do it here at 4acre. I reckon, like, no, you don't know. I'm joking. But I think, like, hearing that mistake, no means no. What categories do we place it in? Credit's one. Servicing, is that another? Like, where are the other places you see the
for
no's?
sure, yeah. Servicing, like, every lender is going to service a loan differently. So, like, if one lender says no, that doesn't mean anything. Yeah, so different policies, different way of verifying income. So, yeah, it's a lot of different options.
Well, to me, I think that screams this out. It's like, if you get a no, one more opinion, one more check.
Yeah. I mean,
one more time.
Sometimes we get people call up and they've been told no, it's because they're unemployed. They're like 65 years old. It's like, okay, well, no one's going to give you a mortgage. Like, that's an extreme case, but
Extremes, right,
so everything's within reason.
Yeah, of course. It's not.
You can't fix that.
Can't fix that.
Why not? No, look, I think that's a big one in terms of just second opinions. That's the big take out of this. Like, when you hear this, if you're seeing a mistake or feeling like, if you're seeing a clear mistake, it's this. I went in, I got told something, I just thought, yeah, okay, I'm not going to do anything. Yeah. Like, this is important wealth building, deposit saving, roof over your head in the area that you want to be in type decisions. Like, don't let one no just be that and don't make that mistake. Now, mate, I used to be in the banks and there was a second mistake that almost all of us used to make in the banks, but without knowing. Still do, but without knowing.
Yeah, that's the important part.
That's the important part. No banker, got taught that this was the
Always
wrong
forgiven,
way.
mate. Always forgiven.
Thank you. Thank you. But at the banks, one thing that's really common is cross-collateralized loans. Ooh, I nailed that in one mouthful. I just got that wrong 3 times today. Cross-collateral. Oh,
just say cross-col.
Cross-col. We're going cross-col? All right, done. So cross-col.
Yeah.
You know, our school, side note, my school in New Zealand, when I went to high school, it's called Wellington College. We used to call it col. Col for short. There you go. Cross-col. There you go. Okay, so cross-col loans, what does it even mean? Why is it a big mistake?
Well, cross-collateralizing loans and properties is basically what it is. So typically you would want to separate the securities. So if you've got 3 or 4 properties, you don't want to have them all crossed and have, all your loans kind of tied together.
So each property has its own loans for own things, rather than I've got 500k equity across 3 properties.
Yeah.
Let me just take one loan that ties them all up and gets me the loan.
Yeah. So this particular client had that issue. They had a cross-collateralized issue.
Yeah.
But they also had, like, the debt apportioning was way out of whack. Like, so when we're dealing with a client, we like to understand the debt that they have and the purpose for that debt. Because the purpose for the debt is, like, from a tax deductibility point of view, you need to know that. And Adrian's one of the best clients for that. Like, he keeps track of where the debt went, for what property, when. If every client did that, honestly, if every client did that, like, I want to implement something that we can try to help the clients keep track of it ourselves. But this client had, like, a 900k loan attached to a property he purchased for 600k. It's like, so you're claiming interest on a property it's not for that property. So technically the accountant should pull them up for that anyway. But if accountants
doesn't make their life easier, right, from the accountant? Mate, it makes their life hard.
No, and so cross-collateralizing it is one thing, right? And a lot of banks, like, when you go direct to the bank, they're not actually trained on how to uncross-collateralize loans. Like, I've had clients that come from the bank and they're in finance writing other people's loans, and they're like, oh, but don't we have to cross-collateralize it? It's like, no.
See, that's a point that, like, we didn't know that.
Yeah.
When we were in the banking days.
You're actually trained to cross-collateralize their loans and properties. Absolutely. Because it's harder for them to refinance just one property. It's to keep them sticky, to keep them complicated. Like, no, we'll manage all this for you. Like, don't take this property out. We'll do all this for you. And it's like, so when you want to refinance one property and something's cross-collateralized, they have to do what's called a partial discharge, not a full discharge. Yeah. So the partial discharge means that, you could have sold that property, right? Maybe you, say for example, you got 4 properties, right? You lose your job, you need to sell one, right? It's a partial discharge. You go to the bank, say, oh, I didn't know, I'm just selling this property, I'm keeping these other 3. They actually, during the partial discharge, they actually do an assessment to see if you can still make repayments on the other 3 properties that are going to remain.
And they're doing all the valuations.
Yeah, otherwise...
So, like, they have to check to make sure that the loans are still in a good spot.
It's not a full discharge, it's partial discharge. So if you've got into trouble, you've had medical issues or what have you, if your property is cross-collateralized and you just want to sell one, the lender can say no. It's like, too bad, you can't sell it.
At least you need to not use your money for your bills anymore. you need to use your money to clear down the loans on these other properties.
Or
'cause
sell
they were
all of
higher.
them. Or sell all of them.
Or sell more than one,
Because
right?
you've in a sale, you've committed to a sale. You're past the finance clause. Someone's buying it, and if you can't settle because the lender's not releasing it, that's because they got the wrong advice and it was cross collateralized. And the bankers aren't trained to do the opposite because it makes for a
look at this. I mean, here's why in the banking days we were there. Like this is what there was. It's one documents from the printer.
yeah.
You don't stand at the printer for all day long trying to print 10 different
It's the same
properties,
for us,
right?
It's the same for us. It's if we got a guy that had 9 properties, we could cross collateralize
And it
everything
could be easy
and
for
have
you.
one application,
Right.
one deal tile to look at, one form to sign.
But you're doing it the harder way
No,
because
we
it's the
do
right thing by
9
them.
separate deal tiles, 9 applications. Could all be with the same bank. Doesn't
Yeah.
matter. We're not cross collateralizing anything.
Yeah. See, so we didn't know otherwise. We just went in there and
Yeah.
did it. And also, the banks thrive in speed as their competitive advantage.
Yeah.
I went into the branch 2 hours later, went out for pork roll,
Yeah.
had an iced coffee, came back, and my loan's approved.
Well, yeah. So what I'll say about that is that going direct to the bank versus going to a broker, going directly to the bank, they don't have best interest duty, right? Brokers are looked at with such scrutiny. It's unbelievable. And then banks can just do whatever they want, basically.
You have to recommend multiple people.
Yeah.
You have to show that you've done it in the best interest for the client, and you can be pulled up on it afterwards to see if you have or have not.
They don't have any of that.
Wow. Now, I'm not, by the way, doing a bank versus broker thing here.
We are now.
Yeah. I guess I'm just trying to say, like, from the other side,
Yeah.
why they were, but I can see why you shouldn't. Right?
Yeah, 100%.
I think that's such an important part. Now, mistake number 3. We talk strategy all the time, Adrian. Property strategy is one thing. Finance strategy. Like people don't have finance strategies. They have property strategies, but they don't have finance strategy. Could you talk about an example where a customer was about to go down that journey and go, all right, more property purchases, here we go. But then you're like, hold on a minute, let's talk finance strategy.
There's 2 parts of that where we had to go, hold on a minute. So for this client, about 4 or 5 years ago, they had 2 properties, earning good money. They were going to go down the path of buying like off the plan house and land packages, units and stuff like that. They didn't know any better, right? They were trusting good marketing and all that. Pulled him aside, said, look, mate, I like you. You should definitely speak to a buyer's agent. So the rest is history, mate. Like from there, quickly got 3 properties. We're now in a position where he's just sold 3 properties, and he's got because of the the capital that was generated from those investments, he's still keeping 2, and he's got the capacity to get a $3 million commercial in a trust, positively geared from day one. Then he's going to go back and purchase more residential property in a separate trust, excluding the first one, and basically rinse and repeat in another 5 years. And mate, he's set. He's only 35 years old.
35, commercial, multiple residentials, massive. But let's take a step back. I want everyone watching, listening to just basically unpack what was he about to do?
Yeah.
Versus what did you come in and go, from a finance perspective, you're not thinking about this and we need to do it like this.
Yeah. So in the Spruker land, the off the plan stuff, they don't have any sort of strategy. It's like, how can we get you to buy as many properties as possible, because we're going to get paid really well for it. And then once you kind of buy as many properties as you can, you kind of just left to, figure it out yourself.
Some people's income's 2, some people's 3, some people 4, but it's like you're done.
There's no finance strategy. There's no talk about exit strategy. It's just like buy as many as you can forever and ever and ever, and that's it. But we know that doesn't work, and it was just about educating the customer, and it's paid off pretty well.
So that's what they were going to do. And then when you come to look at applying the finance strategy for them, what are some of those core steps? Now, we don't have to go to the micro of every single one, but the macro, what are those core steps that you go, they would have done this, instead we did that?
It's just knowing what phase you're in. Like, are you in the accumulation phase? Are you like trying to generate more equity, or have you generated enough equity to be in a point where you can exit into commercial high cash flow and then reset and start to build out the residential portfolio again? So in this case, he was able to exit much earlier, and he was in the accumulation phase initially. And then we quickly identified that, okay, well, now you can partially exit and enter into a high cash flow strategy and then back into accumulation. And yeah, it's just knowing at what phase you're at and what's possible at any given time.
So on the strategy front, this is what I'm hearing here. It's like you could have just purchased 3 or 4 residentials and you're done with. But instead it's like, okay, we went to 3 to 4 or 5 residentials, realized that we were going to have a barrier here.
Yeah.
Exited some residentials, transitioned to commercial using trust lending strategies.
Yep.
Trust lending in commercial meant that the asset was positive cash flow because the deposit wasn't from a bunch of equity loans.
That's right.
It was from multiple residentials that grew and were now sold.
Yep.
And then with that now positive cash flow commercial, it was excluded from servicing. You move on to building residentials again to try and rinse and repeat.
In a separate trust, yeah.
Massive.
So yeah,
Massive,
he hit a bit of a barrier at the 5th property of like terms of borrowing. And it's like, what do I do now? What do I do now? So well, just give it a year. Like you've done really well.
Yeah.
Get a bit more capital growth under your belt.
Yeah.
And then the exit looks much better. And it bloody does. Like
that's an example of 1 step back, 2 steps forward.
Yeah.
Like literally that you couldn't have a better concept of like 1 step back, 2 steps forward, one step back, 2 steps
He was
forward.
pretty highly leveraged in Perth. And it was like, I think it was about 18 months ago. He's like, oh, I'm going to sell these properties in Perth and then go to commercial. I was like, Perth's doing really well.
Yeah, it hasn't come on.
And because of that, he held on and he's probably made an extra 400 grand in equity just from those 2 properties that he kept. So,
well, that's bonus mistake right there. That's like bonus mistake as in just because it's grown a bit doesn't mean the cycle's over.
Well,
fundamentals need to change for the cycle to be over.
When you've held a property for 10 years and it's done nothing, and then in 2 years it just goes, you want to sell.
Yeah.
So I get it.
True, which is why all the people buying have those opportunities to begin with. It's because people are like, I've been here for 10 years, Melbourne's finally picking up, get me out of here.
Yeah,
and then those new Melbourne buyers are coming in and going, oh, Melbourne, I'm going to punt on it, right?
See, it doesn't hurt to wait an extra year, you know, because even if it kind of dies down, it's not going to dip back to where it was. It's just going to, you know, taper out. But
that's probably the fear that a lot of people have as well.
Yeah.
They've held on for so long and they're like, I'm finally going to make a profit.
Well,
let me take it before it disappears.
If you're buying in a mining town, I could understand that. But if you're in a capital city market, it's pretty robust.
Sense. Yeah. I feel like that literally, like, you know, me and you have purchased in Townsville as well, Adrian, and that's grown tremendously. Oh, all 3 of us. Let's go. The crew. Boomed. Yeah. Absolutely boomed. But we think of just what you said then, and it's so true. We only were able to purchase there because someone else was fed up with what they had there.
Yeah.
It's strange how that works, right?
Because when we bought, I mean, I don't know, when we probably bought around the same time, like 2-3 years ago.
Yeah.
Yeah. So when we bought, it was very early on where the people that had owned property there for 10 years had nothing happening.
Yeah. From 2012 to 2022, you wouldn't have actually made any money in these markets. And so you can see why that 21, 22 sales were happening. And now as a result, like they've gone, they feel like they've got this burden off them because of that quick comeback. But then we've gone in and purchased and we've now gained it. Where if they'd helped for 3 or 4 more years later, I know it doesn't help them feel much better because it's over 12, 15 years.
Yeah.
But you could have taken below average to at least the average with just 3, 4, 5 years of holding. So that's mistake number 4. That's a bonus. We just came 4, not 3. Should we change the title to the episode? Or keep it? No, let's keep it 3 and let's go bonus at the end. I reckon that's the way to go. So Jack, thank you so much for just giving some insights on the finance world, because property, as much as we like to say, it's the game itself. Property is actually the game of finance. You're waiting for that one. Hey, you want to be like
that's always the case. It is.
That's
Keep telling you guys. Keep telling you guys. Shout out to SPI.
Yeah. Look, thank you everyone for tuning in. Another episode of the Property Nerds and another finance special with Jack and the team at 4acre Financial. So, Jack, how can people get in touch to just learn more about 4acre Financial and how they can help with finance strategy?
Yeah, so just head to 4acrefinancial.com.au and you can book in an appointment with someone in our client engagement team. Awesome.
And if you've ever wondered, is Jack one day going to buy a property on 4 acres? It's his actual dream. It's his actual goal. 4 acres is going to be real.
Yes.
Thank you so much, and tune into the next one. Thank you so much for tuning into this podcast. To hear more like this and to help us spread the word, don't forget to leave us a rating and follow along for our next episode.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.